Good evening. This is Joe Pryor with the virtual real estate team in Oklahoma City. And what I want to talk to you today about is our market here in Oklahoma City. Is it now back to a normal market? I guess the first question is, what is a normal market? I mean, we haven't had a normal market for a long time. You know, the subprime meltdown, the bubble, really started in the 21st century. It started in early 2000, 2001, and reached its peak in 2006, 2007, and in 2008 it started to crash, and here we are in February of 2011. Now, if you read the newspapers or watch television, get on the internet, you get all sorts of articles about, well, you know, we're past, you know, the market is better, and then you'll have other people saying, oh, no, 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 there's the second double dip coming, and there's a crash coming for a lot of these markets. Now, the one thing that we do know is that not all markets are the same. Oklahoma City, Orlando, Phoenix, Las Vegas, Stockton, California, Terre Haute, Indiana, doesn't matter where it is. We're all subject to different situations, different conditions. And the one thing that I do know from the point of view of reading statistics and experts who are tracking this is that a lot of markets may not even reach normalcy for about 8 years maybe because of the amount of distressed property. There are billions upon billions of dollars of defaulted loans that have not gone into foreclosure yet that are really going to be affecting some of these formerly overheated markets. Now, Oklahoma City did not have the bubble. We did not participate. We were at a different market phase when 2005, 6, 7 came around. We were in a recovery mode. We still weren't up to even probably what would be normally considered a regular value. We're still a little bit undervalued in 2005. So we missed out on that. But every market has been affected by the real estate meltdown all over the country, one way or the other. If you're not going down in a heap, then you're not appreciating. Or if you are appreciating, you're not appreciating much. Now, Oklahoma City has been blessed with a good economy, one of the lowest unemployment rates in the city or in the country at 6%. Did not have the level of foreclosures, which naturally create a drag on the market. For instance, last year, where Nevada was 70% underwater on their mortgages, Oklahoma was 7%, the lowest in the country. So we didn't have that, but has normalcy returned? Now, let's define normalcy at this point for what Oklahoma City would be. First of all, normalcy would be a measure of what we call absorption rate. In other words, it's looking at the overall market. If there's more than 6 to 12 months of inventory based on solds versus the amount of active listings of people that are trying to sell, then you don't have a market in balance. You don't have a normal market. Well, fortunately, over the course of 2010 and getting out of that artificial stimulus of the $8,000 tax credit, we've gotten our inventory levels down. So our absorption rate is typically in that 6 to 12 month range, although there may be a few areas, a few pockets here and there, maybe $1 million homes in a particular market that may have more than that, but then again, they always have more than that. So in a normal market condition, then we're truly talking about supply and demand. We're talking about the fact that, you know, the demand is great. There are buyers out there, and that we do not have an excess of inventory, either distressed or non-distressed. So that's what really starts it. A good economy, a balanced market. And at this point in February 2011, Oklahoma City is a balanced market. So now let's go to some other definitions and some other cliches in real estate that we always use. And the first thing that I learned in real estate school was location, location, location. So right now in Oklahoma City, in the Oklahoma City area, if you're in a good location, if it's not backing up to a busy street, you don't have high power lines coming over your house, you know, things of that nature, then the location is good. Well, okay, that's a start. The condition of property, good. All right, we're going a little further. Now we come to probably the most important law in a normal market, and that is called the law of substitution. Now, what the law of substitution basically is a simple thing. It is, okay, you're a buyer in Oklahoma City. You go into a neighborhood. Both locations are good. The square footage is approximate. They both have great cabinets and granite countertops. You kind of look at the two properties and go, yeah, these are pretty equal. I mean, I could go either way. I could live in either one of these homes. But one is listed at $20,000 lower than the other. What do? You buy the house that's $20,000 lower. That's the law of substitution. Now, when you're in a high repo market, a high foreclosure market, and you're a private seller, you're in big trouble. You're probably going to need to hang on to that house because the law of substitution is really going to bite you, because there's going to be 50 homes that it's $100,000 lower in good condition, and therefore, I'm sorry, Mr. Seller, I love your home, it's really nice, and I know you want that equity, but $100,000 is a lot of money. So in Oklahoma, it's more of a situation that even $5,000 may make the difference. So here's my advice to Oklahoma City sellers that are trying to sell their homes. Look at your condition, bring it up to peak value in that particular case. Don't spend a lot of things that you're not going to get back, but make sure that the curb appeal is good, make sure the carpets are clean, make sure that the paint is good. If you need to repaint it, Make sure that the house comes in, and when people come in, they say, wow, you know, I can go ahead and move my furniture in here. And then look at the market around you. Look at what's in your neighborhood. Look what is immediately outside of your neighborhood. Don't worry about what sold 6 months ago, like an appraiser might do, because that's really ancient history. Because the appraiser is not the one buying your home. He's the one justifying the value. The buyer is looking at your home in a real-time situation. He's going, are you the best deal out there? Because in that particular respect, it's a non-emotional thing. Yeah, there's some emotion that you want to live in that house and have maybe your kids grow up in it or enjoy having parties there, but ultimately, you got to make a payment. So it's very, very important that you're priced right. And then, as all good realtors, the marketing makes the price become aware to a large group of human beings. The marketing doesn't sell the house, but the marketing brings people to the price and then does sell the house. So that's my advice for you right now in Oklahoma City. You're in a great situation. I believe that we really are back to normalcy. Now, nobody can absolutely predict the future. Bad things can still happen, but it looks good at this point. It looks like that we're in a normal supply and demand market. It doesn't look that we're going to have a tremendous amount of foreclosed properties coming on that are really going to cause a dramatic drop, catch other people in the net of negative equity as another situation. So feel confident, price right, and there's a buyer for you. This is Joe Pryor with the Virtual Real Estate Team in Oklahoma City, where we deliver traditional real estate values with the speed of technology.